14 years. In France, their 30-year bond is at the highest level since 2009. So all of this is happening all around the world. And if borrowing costs continue to stay this high for this long, it's going to put a huge pressure on all of their economies. So now let me put it all together and sort of explain what this actually means for your investments. Now, this is not a prediction by any means. It's just a sort of basic overview, but every company and every stock will be a case-by-case basis. But let's take a look at overall how stocks get affected by this. The value of a stock is basically the value of all the cash a company will make in the future brought back to today's dollars. That's something called the discounted cash flow model, or the discount rate. And that rate is tied to the assumption about interest rates. So when yields go higher, those future profits get discounted more heavily, which makes the stocks worth less today. This is why high growth tech stocks usually get hit the hardest when interest rates go up. They make most of their money into the future, so higher rates compress their values more. That's why we might see stocks become more volatile, and they go up and down when news like this happens because investors don't know what to expect from the bond market. Mortgage rates are also tied to long-term treasury yields. And if the 10-year treasury is going higher, then mortgage rates are also going to stay high too. And that makes it more expensive to obviously buy a house, which pushes affordability down to levels we haven't seen in decades. So if borrowing costs stay this high, home prices will either have to stall or come down. But right now, most people think if interest rates come down, home prices will explode. Now, I don't know if I agree with that. The contrarian point of view is that at best, home prices will stay flat or they'll grow at 1% to 2%. And at worst, we might see deflation as rate-locked owners list their homes, which could flood the market with more inventory, which puts downward pressure on home prices. Combined with weak jobs reports that we're seeing, and you get potentially deflation or stagflation. Then there's what people call hard assets, like gold. Normally, when real yields or rates go up, gold goes down. But this year, both are going up together, which is a really rare signal that investors are losing trust in the whole system. The way it's supposed to work is if bonds are paying a comfortable interest rate above inflation,